Hey traders, it's Matt. I don't know if a lot of you traded today. I tried to get on the forum and ask what everybody was trading, but I got crickets. So hopefully you had a good holiday today, President's Day. I was trading. I'm not saying you're slackers. I'm saying I'm boring. But there turned out to be a really good trade that happened, and I thought this would be a good opportunity to, especially for those that are going through the high basing pattern strategy right now. This one's a really good example of what can happen. So this is the pound yen today. It's the 15-minute chart. And so the whole reason that basing patterns form is because there will be a quick run up. You know, buyers will take over, as we can see here in this histogram. Buyers will take over and run the price up quicker than, and this red line shows the sellers, and you can just, they're taking a nap most of the day. But then they get to a point where they get far enough away from the 20 and the 50 period SMAs that that makes them uncomfortable, right? Because the 20 SMA especially is usually a support line. The closer they are to that, the better, the warmer they feel inside. So they don't mean to do that, but you know, it happens all the time. So they run up and then they get a consolidation pattern like this. And this is called a high base. And these are all high tight bases. And there's one going on, but I think this pattern has run its course, and I'll tell you why. So typically, as those of you who've traded these know, we typically miss the first one, because how would we know it's a high base unless there was that run first? So we usually catch it on the second one, hopefully. Hopefully not the third. But that, in this case, that still would have been okay. So what I've done is I've drawn this green line is the entry point on my trade. That's the high of the basing pattern, and this red line is the stop loss that I'll have if it gets triggered, if and when it gets triggered, because that's what we do. This is the stop, because if the price goes up and then turns around and comes back and actually goes through this support level, well, that's the very definition of a reversal, and we definitely should not be in that trade. So that's why we have the stop loss at the lower end of the base and our entry just above the high end. So you see, I got triggered here and it ran up again, and see it gets pretty far from the 20 and the 50 again. So we get up here and they figure, okay, we need to wait, let the SMAs catch up. And this down here, I mean, look at the buyer conviction and presence with respect to or relative to the seller conviction and presence. I mean, the sellers are just nowhere. Now, these dark red lines mean that there are more sellers than the orange lines, but again, they just don't. I mean, they pop up barely right here. And usually these consolidations, unless you see a lot of red volume and you see this red line spike up a little bit and go over the green line, it doesn't mean that sellers are entering. That's not what this consolidation is about. It's really just some of these people that profited here are taking profits. That's why all these candles are so small. There's not a lot going on. And then suddenly we get the buyers coming back in here. We get the volume coming back up, and it breaks out in good fashion out of that resistance level. And that's where I'm triggered. Now, this one gave me a few opportunities to leg in. Now, for those of you who don't know what legging in is, I got sick of, so I used to do a standard, amount per trade. Let's say I wanted to do a standard lot trade, but my risk protocol states that I can't have any more than 2% of my account balance at risk in any one trade at a time. Well, sometimes that would make the stop loss really tight. And the worst thing in the world you'll ever feel as you're trading is you get into a trade, it hits your stop loss, turns around and just starts soaring. That will ruin your month to see that, to know you were right and you didn't get to experience it. So, and there's we have a great video on legging in, but what I started to do was cut that standard lot, that 100,000, into half or thirds. And that way I can have a stop loss that's 2 or 3 times the distance from my entry point. So it gives, as long as you're setting up the trade right and you're recognizing the pattern correctly, it'll give the trade more breathing room to work. And it's worked wonders for me. So now I don't get stopped out so much. And even if I do, just because that stop loss is further from the entry point, again, since I took a half or a third position, or I'll take a 2/3, whatever, I'll calculate it, I'm still not risking any more than 2% in that trade. I'm just giving the trade a better chance to work for me. This one didn't really need it. It just, this is like the ideal high basing pattern chart. And I mean, you'll see there are a lot of parts of it that are just ideal. Anyway, so you can see this is the run until the next resistance point in this high basing pattern. And so when it breaks above that, I will leg in again. So if I went half here, which I believe I did, I'll make up for it here. And when I do that, what I do now since we have a new, whenever it breaks above resistance, and this was the support line, now this becomes our new stop loss. We raise our stop loss from here to here. And especially if you're practicing legging in, that's very important that you're moving the stop loss up. Because I'll mention here in a second, when I do these two, I'm using leverage. So, and I have a little calculation on in Excel to help me figure out where I need to put that stop loss in order to not have more than 2% at any one time at risk. And it's usually the case that I'm so far in the money by the time I'm doing that I'm really just playing on the house's money. So one thing that concerned me was this pullback right here that happened. There was some decent volume, but as you can see, it's the definition of a bull pullback. Look at the volume on the left of it that took us up again, and on the right that takes us out of it. Those volumes are bigger than the volume that took us down. Plus, we still see the sellers they're still nowhere to be found. So, but I did want to do a Fibonacci retracement line and see, because again, you all know if it goes past that 0.618 line, I'm out. And this line right here actually represents that line, which is interesting. So it looks like it hit that line and just bounced. Came up again, did another high basing pattern. So bull pullbacks and bear rallies are excellent chances for us, excellent opportunities for us to leg in. I do a lot of legging in with those two patterns. If I started the trade in a high basing pattern, even if I started the trade in a bull pullback, you can still find them. And they're excellent opportunities to get in again. But you got to wait for that confirmation candle, which I did, which is this one. Probably should have been this one because it went above this, the prior red candle's high of the day. But I got in here, and this thing was kind of a run into a new high base. And then I legged in again here with leverage. And at that point, you want to, again, bring the stop up to your new, if it ever goes below that, what was resistance becomes support. What was support becomes resistance. If you're going down. But anyway, but now I'm out of the trade. I consider this kind of, I don't want to get greedy. I've never seen, I've seen 4 platforms before, 4 high bases, but they don't usually go much further. What I wanted to do is see how close these were to each other, because the targets we use on these a good rule of thumb is, oh man, I put it right where I shouldn't have. There we go. So a good rule of thumb is the target you should have in mind, and remember, target prices are they're nothing more than educated guesses. Never set your targets as hard, sells. Oh, if it hits, my target of 1 ATR, I'm out no matter what. No, I've seen way too many traders do that, and I've just watched as it just kept going. Always follow price action first. That trumps any price target. Because think about it, price target is really just a guess. It's an educated guess, but it's just a guess. But usually, look at this. These two are exactly the same distance. This rise to this top of the base, and then this one to that top. This one looks like it's a little further, and it just looks exhausted. The buyers are coming way down. Stochastics look really ugly. You don't see a 90-degree angle straight down very often. And the CCI, again, remember that the CCI, the Commodity Channel Index, is a good secondary indicator for basing patterns. So you can see every time it breaks out, it breaks out above this 100 line. And when you do low basing, it'll break below the negative 100 line. Anyway, I think that's it. Now, one of the things I was going to tell you is one of the reasons we get out of a trade. I go to the 15-minute chart when I'm looking for my exit, and one of the reasons is the parabolic SAR, so these white indicators, flip sides. That can indicate that the trend is reversing. Now, I know that happens here and it happens here, but if they flip sides and they're flat, I'm not really worried about it, especially when there's no sellers and, stochastics weren't dropping off a cliff back here. And it's not necessarily why I did it here. I just felt like this thing had reached exhaustion. The volume back here is a lot more than the volume we're seeing now. So I felt like, let's not get greedy. And it's about to break below the base of that high base. So that's the definition of a reversal. Anyway, but great opportunities today. Hopefully a lot of you were trading, or at least had a chance to look for some trades and patterns and practice. But that's all I have for you tonight. Let me know if you have any questions, and we'll talk to you guys soon.